Look at some of the hedge fund indices, and then you look at what the S&P did. 2012 was not the best of years.
You know, the average hedge fund in 2012 was up about 6%. And people's expectations for hedge funds have come down significantly. You know, it used to be that people were expecting 10% plus with their hedge fund investments. Now they're only shooting for about 6 to 8. And 6 to 8 in this type of environment is not bad. You know, I think you're going to see some pretty hefty flows going to the hedge fund industry, primarily because a lot of pension funds are going to be shifting money out of fixed income, which is expected to return 2.5 to 3%, into hedge funds where they're expecting 6 to 8%.
But why move into an actively managed fund if you're seeing similar returns with passive funds, and of course fees are lower?
I don't think you are seeing similar returns. You know, as I mentioned, on the fixed income side, going against the aggregate index.
Let's say a long short strategy.
Well, you know, long short has been very difficult for people focused on that space because the equity markets have been driven by macro events. And I think going forward, you're going to see fundamentals matter. And when fundamentals begin to matter and drive stock prices, you should see long-short equity managers do very well. Long-short equity managers did very well relative to the S&P the 10 years before 2008. Since then, they've underperformed the S&P 500. But I think top managers will again begin to generate some pretty strong alpha.
What other strategies look promising this year?
You know, I think there's still room to go in structured credit. Structured credit has done very, very well over the past couple of years. You've seen spreads come down, which has enhanced your market value gains. But I think structured credit managers that can also trade their portfolio could generate low double-digit returns. I also think private lending could do pretty well. Spreads have come down, interest rates have come down on very liquid securities, but in private lending, the spreads are still pretty wide and you can get pretty good returns. Again, I think you can get low double-digit. I think long-short equity is going to do well in 2013. And you also may see a rebound in CTAs. CTAs have lagged the past 2 years. They are uncorrelated with long-only benchmarks. Typically, when you see a big drawdown for CTAs, they bounce back. So 2013 could be the year for CTAs.